Germany's bond yields are ripping higher within 3 basis points of a 14-year high, potentially spelling major problems for the US bond market. What's behind this bear steepening of the yield curve? The fiscal policy bombshell and soaring long-term interest rates. So here we can see the yield curve for Germany. Again, the short durations are lighter colors going out the direction of the rainbow. So 30-year Bund yield is in purple, 10 years in blue, green is the 5-year, red is the 2-year, yellow is the 1-year, and white is the 3-month. And what we can see down here is the spread between the 30-year Bund yield and the 2-year Bund yield. Well, that difference, that gap is growing wider, indicating a steepening of the yield curve. And it's called a bear steepener because it's bearish for bonds. As we can see, the value of the bond is inverse to the yield, and the value of the bond is declining. Therefore, you get higher interest rates. Now, this is important because much like the US, this is coming despite central bank interest rate cuts. So we went from an inverted yield curve here in 2022 and 2023. We went into a steeper yield curve, but the problem is it's a bear steepening. So this is, again, bearish for bonds. And again, the other point to consider is that this 30-year Bund yield, you have to go all the way back to 2011 to reach a point in time where the 30-year Bund yield was this high. So what is going on in Germany, and why does it matter for the U.S. bond market? Why could it be very detrimental for the U.S. bond market? Here is kind of overview of their economy. We can see they run a very large current account surplus. Unlike the U.S., unlike the U.K., they run a large current account surplus. This is driven by 20 billion euro trade surplus. So unlike most of the West, they run a very large current account surplus. At its peak here in the early 2010s or the mid 2010s, it was as high as 8.5% of GDP. This is very, very strong. And as we can see down here, they do run a fiscal deficit, although it is much smaller than, say, the US deficit, which is 7% of GDP. However, we have to look at the structure of their economy to see why they are different and why some of the forces at play matter in the interplay between them. So, of course, much like most of the West, government spending and public administration, as well as services, play a very large component of their economy. Construction and agriculture, very small, much like most of the West. However, look at manufacturing. So unlike the US, especially, and to some degree the UK and other countries in the West, Germany has not hollowed out their industrial base. In fact, manufacturing is one of the top components of GDP, contributing about 167 billion euros in terms of GDP. They are an industrial powerhouse. Well, here is industrial production on a year-over-year basis, as well as business assessment and business expectation. And what I want to point out, this is kind of similar to the ISM services or the PMIs that we see in the US, the purchasing managers surveys that go out, the soft data, the survey data that shows a pretty strong correlation between industrial output, and you are getting an uptick in business expectation. So current business assessment remains quite poor. However, the future expectation is starting to tick up. And what we can see with industrial production as well, I will take the survey data off. What we can see with industrial production, which again is a very large component of their overall economy, industrial production has just gone positive for the first time in since May of 2023. Now, again, this is a major component of their economy. It is starting to tick positive. And again, bond yields are supposed to approximate nominal growth. So we can see they've been basically in contraction, as we will see in a second. They've basically been in contractionary territory for a couple years now, flirting with a recession. So we have to wait and see if this is durable and if this sticks. But if it does, you will have a higher nominal growth environment. Germany's economy will be increasing in terms of its output. Well, that means higher GDP. And remember, bond yields or Bund yields here in Germany, we can see are very similar to a government bond yield anywhere, which is that they're supposed to approximate nominal growth, which is inflation plus real GDP, with some degree of fiscal premium baked in. So talking about that fiscal premium, there is a bit of that being driven into the higher Bund yields that we're seeing. So last Thursday, the German Finance Agency announced its quarter 4 debt issuance, which again, this is the deficit, the fiscal deficit, or the gap between government spending and revenue. They are increasing their debt issuance. They have to sell more debt than they had expected by 15 billion euros compared to the December forecast. This is 20% higher than expected. Now, going back to the first slide, we can see their fiscal deficit about 3% of GDP. So there is definitely an increase in the budget deficit, in the fiscal deficit, and that is going to drive to some degree higher interest rates. So here we can see government spending. This is final consumption expenditure running at about 207 billion euros on an annual basis. But government spending as a share of GDP is relatively tame. It is in a slight uptrend since 2008, but we are not seeing an outright explosion higher in government spending in Germany as a share of GDP. It's only at 18%. Now, of course, this is not total government spending, just final consumption expenditure, but it is worth noting that it is somewhat tamer compared to, say, the UK or France. Now, what is driving the government spending spike that we can see here from about 175 billion euros to 208 billion euros? Well, it is military expenditure. So this is increased from about 55 billion euros all the way up to 88 billion euros. So up about 75% increase just in the past couple years. This is, of course, driven by some of the events in Eastern Europe, but also pressure from the Trump administration. This is a story that goes back to his first term, where he was very vocal about pressuring Europe to, quote unquote, pay its fair share, pay more in terms of military expenditure for NATO defense. Well, with recent developments in Eastern Europe and Germany's proximity, there has been a notable increase in military expenditure. Again, up about 75% over the past couple years. And this is what has driven government spending kind of overall. This is part of what is driving government spending up. So here's just kind of a brief comparison to US GDP per capita and on a purchasing power parity basis. We can see that their GDP per capita on a purchasing power parity basis is almost in line with, this is a constant in dollar terms over here, almost in line with US GDP per capita. So Germany's economy, they have been to some degree a safe haven and a relatively a good place to park some of your money. Now, here is GDP. So they, much like most of the West, have been dealing with a disinflationary trend over the past couple years, falling inflation from about 8.4% down to just 2%, so lower, significantly lower than the US, but that's also come at lower growth. So in white, we can see real GDP, well, that has come in, but they have been basically flirting with a recession going back to January of 2023. So about 2 years or so, 2.5 years or so, they have been flirting with 0% GDP growth rate. Now, part of that government spending story, here we're going to look at the rate of change of government spending. And we can see that at the peak here, it was up about 17% on an annual rate of change basis in July of 2024. It has come in, it's growing at about 2.16% currently, but there was a massive spike in government spending, again, driven by defense spending. Well, again, bond yields are going to approximate nominal growth. So if you get an increase in government spending, especially given the fact that when people talk about the wartime economy, and an economy is in a recession or they're not doing too well, so they'll just start a war because the war is good for the overall economy. Well, that was the case back when these Western countries were industrial. It's not necessarily the case very much anymore. Of course, you get a deficit during war. That is somewhat stimulatory, jumpstart for the economy. But then also your industrial sector does very well. Well, that's not really the case for the U.S. anymore. Such a small share of GDP comes from the industrial sector. But that is the case for Germany. So a boost in defense spending will be a boost for manufacturing and for industrial output, which, by the way, is just starting to tick up into positive territory. Well, again, that is such a major component of their overall economy that you would expect to see higher GDP. Well, again, higher GDP, here we'll take a look at nominal growth running about 2.2%. This is just GDP plus inflation, running about 2.2%. Well, if you get higher growth, higher GDP, because you're running a larger deficit, as we established, and that deficit a major driver of that deficit is going to defense spending. Well, defense spending, very industrial. Your economy is very industrial. So hopefully that intuitively makes sense. You would expect to see a pretty significant uptick in their overall GDP or gross domestic product. I should note that unemployment has been ticking up, much like the US and most of the West. We have been trending up in terms of unemployment. But if you could jumpstart the economy with a large deficit, a lot of defense spending, that'll boost, kind of jumpstart your industrial sector, which, by the way, has been basically in a recession for at least 2 years. Then you would expect higher growth. Well, there's also going to be so higher growth will drive higher interest rates in boons, but you also have again the fiscal component and an increasing term premium from higher government spending. And so you have both of those factors that are likely to put upward pressure on rates. Now, it's important when we go back to look at the yield curve, look at the 30-year bond yield. It is about 130, 140 basis points lower than the US 30-year bond yield. And the reason for this, of course, part of it is lower growth. Their nominal growth is 2.2, and US nominal growth is 6, running at about 6. So lower growth is certainly part of it. But another part of it is that Germany's very, very strong current account surplus and what relatively healthy economy is has been a bit of a safe haven for global capital. Now, eventually, there will be a higher interest rate up here with boons that will attract some of that global capital that has been in U.S. Treasuries into Germany. So again, what have we seen over the past 9, 10 months? We've seen the dollar, traditionally a safe haven, we've seen the dollar weaken. Well, what has taken its place? The euro. Well, what's better than being in euros? Interest bearing euros. So that is what a bond is. Just like a US Treasury is an interest bearing dollar, and you want to be in the dollar or an interest bearing dollar during a bull market for the dollar. Well, if you're in a bull market for the euro, what's better than that is interest bearing euros. So to some degree, there might be some capital flight, capital rotation out of America and into Germany. So let's take a look at the equity market, the stock market. Here we're looking at the S&P 500 in dollar terms, up 13% year to date. Very strong performance. However, once you look at the S&P 500 adjusted for that dollar weakness that we just noted, down about 11% year to date, well, it's actually down on the year. So, once you account for the fact that the dollar has weakened so substantially, the S&P 500 has basically gone nowhere in euro terms. So let's look at the DAX. This is the German stock index. Well, this is up about 17.5%. And again, some amount of that is the euro, but even removing the euro, it is still up even in dollar terms. So the DAX has been seen as a bit of a safe haven, especially with this kind of jumpstart to their economy and an expectation of better growth into the future. Now, it's been basically range bound going back to June, but it is up 17.5% on a year to date basis in euro terms. This is much better than the 13% in dollar terms for the S&P 500. And certainly, if you're a European investor, the S&P 500, you're basically down on your money. Even though it's ripped higher in dollar terms, you are down if you did not hedge your currency exposure. Now, just for comparison's sake, the CAC, this is the French stock index, up about 6.7% in euro terms. So here are a couple spreads that we're going to look at. Here, for example, is the Italian 30-year yield relative to the German 30-year yield, as well as the French, Great Britain, and the US. So I will include the US on here as well. What we can see, all of these countries post 2008, all of these countries have a higher interest rate than in Germany. So again, this is a reflection to some degree of that safe haven status where, again, as global capital is flowing into German bonds, well, that puts upward pressure on the bond, the value of the bond, therefore downward pressure on the interest rate. This is historically what the US benefited from by being the reserve currency, is global capital wanted to be in US Treasuries, therefore that kept US Treasury yields kind of lower than they arguably should have been. Well, to some degree, we see that with Germany. We see lower interest rates than Italy, France, Great Britain, and the US. But what is important to point out is here's the interest rate differential between the US 10-year yield and the European average 10-year yield across various different European bond yields. And then here in red is the dollar euro. And what I want to point out is going back to late 2022, there's a pretty strong correlation between strength of the dollar and the degree to which you get a higher interest rate in American bonds. If you get a higher interest rate in American bonds, well, global capital wants to buy those bonds. They get a higher interest rate, and therefore they have to buy the dollar first. So that puts upward pressure on the dollar, and then eventually, when the bond is bought, it puts upward pressure on the bond and lowers the yield or the interest rate. And so there's been a pretty strong correlation between the interest rate differential and the currency. But if we go back to April, what we can see is that the dollar has weakened substantially. And despite that, U.S. rates are actually higher than they were on April 2nd. This was the Liberation Day chaos. We can see that the U.S. 10-year yield is actually higher relative to the European average 10-year yield, and yet the dollar is substantially lower. Now, if this continues, again, one of the consequences of higher bond yields for a healthy economy with kind of a jump start in growth and this spike, this jump start via mainly defense spending and therefore industrial output and therefore GDP, well, that'll drive nominal growth higher, that'll drive rates higher. But if there's also some degree of kind of a safe haven status, a higher bond yield could incentivize global capital to flow out of what it historically has been in, which is, again, U.S. Treasuries. Well, that's exactly what you would see. So what we saw during April, during that kind of week or two in the start of April, this was around the time we started the channel, by the way, and we noted this, but you saw a spike in U.S. rates. So U.S. rates moved notably higher, and yet the dollar moved notably lower. So the dollar weakened. What that indicates, again, if you're a European investor and you're in U.S. Treasuries, well, you sell the U.S. Treasury, puts downward pressure on the bond, upward pressure on the interest rate, which is what we see here with the rate in the U.S. spiking far above what the European average was doing. And then you're left with dollars. Well, you don't want dollars because you want to get into, I don't know, the yen or the Swiss franc or the euro. So then you sell your dollar, or put another way, you sell your dollar to buy euros, putting downward pressure on the dollar euro. And that's sure enough exactly what we've seen. So we'll have to keep an eye on this to spot that kind of global capital rotation where you get an ever widening interest rate differential, which theoretically should attract global capital into your bonds, but actually your currency weakens. So this is something that we're going to definitely have to keep an eye on because, again, Germany, with this fiscal expansion, this boost and this jump start to their heavy industrial economy via the defense spending, well, that'll be a boon for their GDP, which, again, they've been flirting with recession for a couple years now. That'll be a stimulus for their economy, and that'll provide higher nominal growth. Well, that'll cause higher bond yields. Not only that, but if the fiscal deficit and government spending and the deficit continues to surprise to the upside, well, that again will also cause higher bond yields because, again, the way the deficit is financed is by debt issuance. So if you're surprising the market, the bond market, with, hey, we're going to actually have to issue way more bonds than we thought, well, remember, that puts downward pressure on the bond and upward pressure on the yield. The bond market's going to price that likelihood in with lower bond value and higher yield. So both of those factors are kind of driving the German bond yields higher. And again, eventually, this will become attractive to global capital, which historically has been in U.S. Treasuries. So we're going to have to watch the interest rate differential relative to the currency, especially the dollar euro. But the dollar euro has been in a pretty significant downtrend. Now, remember, this is part of the goal of the Trump administration. The dollar on a purchasing power parity basis in 2023 was even more overvalued than it was in 1985 going into the Plaza Accord. So, with their goal of reindustrialization, they need a fairly valued dollar. Well, a fairly valued dollar is much lower than it currently is. The problem, of course, becomes Europe is the US is the only country dumb enough to want an overvalued currency. Europe doesn't want it. Switzerland doesn't want it. Japan doesn't want it. No one wants it except the US. And the ECB, or the European Central Bank, has made it clear that anything above 120 on the dollar euro, or euro dollar, excuse me, anything stronger than that, and they will probably do things to weaken their currency. Because again, if you have a strong currency, that will cut into your ability to sell things to the rest of the world. That will hurt, especially Germany. So the euro strength is definitely something to keep an eye on with Germany, because if the euro gets too strong, that could hamper what has historically made them so strong, which is their industrial output and their very, very healthy trade surplus, about 20 billion in euros. So hopefully that made sense. We're going to have to watch this, because eventually there is an interest rate that attracts global capital into boons and out of bonds in the US. This again puts downward pressure on US treasuries, upward pressure on interest rates. So, anyways, hopefully that was helpful, and I will catch you on the next one.